One of my biggest pet peeves is when dividend experts peddle super high dividend yielding stocks, saying that they're a good investment. Now, a high dividend yield is obviously better than a low one, all else considered. But in many cases, these stocks have a lot of underlying problems that are not readily apparent and not readily discussed by a lot of the people that recommend the stocks. So, to prove that dividend yield was not the best single ratio, I decided to set up a little experiment.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
In this experiment, I decided that I would buy 30 different stocks, and I would put roughly $33 or $1,000 total in these 30 names. And to pick these 30 stocks, I looked at the S&P 500's sectors and basically made the portfolio sector neutral, ranked by different valuation criteria. So for example, at the time, there was about 25% in the technology sector, so I decided to roughly equal weight that sector. So I would buy 8 stocks that were in the technology sector times 3.3, which would be roughly 26%, which is, close enough to 25. And then, for example, the utility sector has 3% weight in the S&P 500, so I bought 1 utility, and so on and so forth for all 11 sectors. One of the portfolios I did was dividend yield. So basically, I bought the 8 technology stocks with the highest dividend yield. I bought the highest dividend yielding utility, etc., etc. Another portfolio I made was based on what I thought would be the best performer, and that was shareholder yield. Now, shareholder yield is simply a combination of the dividend yield and a stock's buyback, or in some cases, subtracting what a company dilutes, meaning they basically sell new shares to other people and reduce the net value of a shareholder's position. There were 3 other portfolios as well. I did the forward price to earnings ratio flipped upside down, so it was basically the highest earnings yields in each sector. I also did one based on a modified free cash flow yield, which I called the Buffett ratio or the Buffett yield. And then the last, I did the operating income before interest and taxes divided by the enterprise value. When I set up this experiment, I expected to try to find which of these ratios would do best. But what I actually found out was something completely different. I basically got pretty busy with work and I had another child, and I basically just completely forgot about these portfolios until one day someone on YouTube actually asked me if I could relook at this little experiment that I had made and published on my channel. And when I checked, I was shocked at how well these portfolios had all done. Anytime you're looking at investment performance, you always need to look in the context of what similar investments would have produced. So here's a chart showing the total return of the S&P 500 index here in the dark blue, so roughly 46%. The light blue line is the Vanguard total value, or VTV. This is a price chart, so if you actually look at dividends reinvested, this fund generated 48.7%. And I included this because the fund I made was basically a value fund. So it could be that my performance was really good just because value did better, which it did by just a little bit. And then also for reference, I included here the VYM portfolio, which is the high dividend yield. This produced a 46.7% total return when you reinvested the dividends. So based on this time period, I would have expected my portfolios, being roughly value portfolios, to generate about 49% as a whole. They actually did far better than that. My initial $5,000 investment grew to $8,236, and this is as of July 31st, 2022. Which would be a 62.5% return. Perhaps more impressively is how each one of these sub-portfolios did. So the worst performing strategy was the high Buffett yield, which was basically free cash flow divided by enterprise value. I thought this would do relatively well, but it really didn't. It was the worst performing portfolio of the 5. but it still outperformed VYM, VTV, the value index, and the S&P 500. And you can see it got even better from there. The high operating income to EV yields, that portfolio has generated about 56%. 59% for the stocks with the highest forward earnings yield. So it was the blended forward 12-month earnings per share estimates at the time. So as of May 2022, and then just divided that by whatever the price was at the time and chose the highest stocks. That portfolio did 59%. And then to my surprise, the high dividend yielding portfolio actually did quite well. It was up 74% over this time period, and this does include dividends reinvested on this one and all of these portfolios. But as I predicted, the high shareholder yield was actually the best performing strategy, up over 76%. So what were the drivers of this extremely good performance? Well, if you have seen any of my videos on the coffee can portfolio approach, there's an idea in investing that's basically just a mathematical reality that if you put $1,000 into a stock, the most you can lose is 100% or $1,000. Meanwhile, the most you can make is basically unlimited. So there's this fixed downside and unlimited upside. The basic idea of this is if you bought a portfolio of, say, 30 stocks and held it for 30 years, you are likely to have a bunch of businesses that really don't do all that well, but you may have just a few that end up doing so well that those few stocks generate all of the returns from the portfolio and make up for all of the losers. You can see this concept in a ton of different research, which I will maybe go into in other videos, but it's a fascinating concept. And what you see with my portfolio after just a couple of years is the similar phenomenon. So in this part, let's take a look at the different winners and losers from the portfolio. And this here is the shareholder yield portfolio, since that was the best performer. The worst performing stock has been Comcast. It was up 9.3%. And then here's also the next four at the bottom. I did harvest a couple losses last year, so there may have been a couple that did actually worse than this. I needed a couple of tax write-offs. In hindsight, I wish I wouldn't have done that, but anyways, this is pretty much maybe the worst performers with the exception of maybe a couple. But you can see that since these started out at between 3 and 4%, a lot of these are now 1.8, 2.6. So the losers in the portfolio are becoming less and less relevant. Here are the top 5 best performing stocks. All 5 of them are up over 130%. Again, no skill of mine in picking these. This is just kind of lucky, I suppose, that these did what they did. But AMAT, Ameriprise, McKesson, and Discover all up between 130 and 170%. And then the biggest winner of the portfolio by far is PWR, or Quanta Services. I have no idea what they do, but they generated a return of 305%. And whereas the losing positions are getting less and less relevant as time goes on, these winning positions are making up an even larger percent of the portfolio. These portfolios have done exceptionally well, and they also have lined up with the coffee can idea. So I think there's a coalescing investment concept that's coming together for me, and I really want to explore this a little more. And I believe in it so much that I would like to start another portfolio that's based on this very concept, and I'm calling it the Coffee Can Experiment Portfolio. I'll talk more about that concept in my next video. For those of you that support me on Patreon or YouTube, you can access that video today. And I'll also be sharing with Patreon and YouTube subscribers the portfolio that I'm accumulating over time. I haven't done that up until this point just because I don't like the idea of people just blindly following whatever someone's portfolio is. I don't think that's a particularly great idea. So this is just going to be an experiment, and I think by keeping it just kind of within a smaller group of people, I feel a little bit more confident knowing that this hopefully won't be abused or taken as investment advice. All this is just an experiment. I don't necessarily encourage that anyone would go out and do the same or copy what I'm doing, but I think it could be a fascinating look and real-time example of what happens when you just buy a group of stocks based on some preset criteria that makes some sense, and then just let them go for at least a decade. So again, in the next video, I'll talk more about the details of that particular strategy. And then for Patreon subscribers, I'll share the initial starting portfolio, and then the idea is to add to it each month. So I'll keep updating that portfolio as time goes on. So thank you very much for watching, and I will hope to see you in the next video.